Happy Thursday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, yesterday, Wednesday, the US Federal Reserve opted to keep its benchmark interest rate unchanged for a second consecutive meeting, navigating the dual challenges of slowing economic growth and persistent inflationary pressures. Fed Chair Jerome Powell acknowledged the heightened uncertainty stemming from President Donald Trump's policy decisions, but emphasized that the central bank is not in a rush to adjust borrowing costs, expressing, quote, "We can wait for greater clarity on the impact of those policies before acting." End quote. The Federal Open Market Committee, FOMC, voted to maintain the federal funds rate within the 4.25 through 4.5% range, while also slowing the pace of balance sheet reductions. Notably, Governor Christopher Waller dissented over the decision to taper the runoff, preferring to maintain the current pace. Powell linked rising inflation to tariffs imposed under Trump's administration, acknowledging that further progress on inflation control may be delayed. However, he maintained that any inflationary efforts from tariffs would likely be transitory. Markets responded positively to Powell's remarks, with the S&P 500 edging higher and Treasury yields declining. The Fed's updated projections signaled a more cautious outlook. Growth estimates for 2025 were revised down to 1.7% from 2.1%, while the core inflation forecast rose to 2.8% from 2.5%. The central bank also projected a slight uptick in unemployment, now expected to reach 4.4% by year-end. Despite concerns over economic uncertainty, Powell pushed back on fears of an imminent recession, citing stable economic activity despite declining consumer sentiment. As Trump's trade policies continue to shape the global landscape, the Fed remains cautious, balancing inflation control with economic stability while signaling a wait-and-see approach before any further monetary policy shifts. Meanwhile, global investors have slashed their holdings of US equities by the most on record, marking a dramatic shift in sentiment, according to Bank of America's latest fund manager survey. Fund managers now report being about 23% underweight in US stocks, a steep decline of 40 percentage points from the previous survey, signaling a massive rotation in global markets. The shift comes as the S&P 500 has tumbled roughly 8% from its February peak, with concerns over high valuations and sluggish economic growth weighing on sentiment. Bank of America strategist Michael Harnett noted, quote, "Peak US exceptionalism is reflected in record rotation out of US stocks." End quote. While investors are pulling back from American markets, European equities have seen a surge in optimism, with Germany preparing to inject billions into defense and infrastructure spending. Allocations to Eurozone stocks have risen to their highest levels since 2021. We will be discussing this later in today's video. Conversely, US stock allocations have dropped to their lowest since June 2023. The survey, conducted between March 7 and 13th, with 171 participants managing almost $500 billion in assets, also showed rising caution among investors. Cash levels have jumped to 4.1% from 3.5%, marking the biggest increase since 2020. Defensive sectors such as consumer staples gained favor, while tech stocks saw sharp declines. Although the S&P 500 has rebounded after entering correction territory, Arnett suggests it will only break above 6,000 points if trade war and inflation fears subside. Next up, we move across the Atlantic to Europe. The ruling Labour government in the United Kingdom, the UK, has unveiled a controversial package of cuts to disability benefits aimed at saving over £5 billion annually by the decade's end, approximately $6.5 billion. The reforms, introduced by Work and Pensions Secretary Liz Kendall, have ignited fierce opposition both within and outside the Labour Party, with critics warning that up to 1.2 million people could lose support. The key proposal would restrict incapacity benefits for those under 22, with Kendall arguing that the system, quote, traps people, end quote, on benefits. Critics, including Labour MPs, say the changes unfairly target vulnerable individuals to address a fiscal gap. Tightened eligibility for personal independence payments, PIP, is expected to remove support for up to 1.2 million claimants. Kendall declined to specify numbers, intensifying concerns. Labour backbenchers, including Debbie Abrahams, warned against imposing cuts on disabled people. Those in support of the cuts, however, point out that the amount of people that have become eligible for this benefit has dramatically increased over the years, suggesting there are many who perhaps should not be on this system who are enjoying its benefits, and that this is a tremendous fiscal drag. Labour is seeking savings before the Chancellor's spring statement. The benefit cuts are expected to generate £6 billion, with £1 billion reinvested in employment programmes. Incapacity benefits will be frozen for existing claimants and reduced for new applicants. Universal credit will rise slightly above inflation, but health-related top-ups will be cut. To ease backlash, Kendall pledged in, quote, additional premium, end quote, for individuals with severe lifelong conditions and plans to integrate incapacity assessments into broader disability support. Despite concessions, Labour MPs remain divided. Clive Lewis called the reforms uncharacteristic of Labour, while Conservatives argue that they do not go far enough. Starmer, the Prime Minister, faces mounting dissent as he pushes the reform forward. Next up, we move to Asia for an especially interesting update. But just quickly, if you're getting some value from today's episode of Market Update, don't forget to hit the like button. And if you want to be on top of the most up-to-date analysis as it's released, maybe consider subscribing and hit the bell notification button so that you do. Asian defense companies are witnessing an unprecedented surge in stock value as European nations seek alternative suppliers following US President Donald Trump's threats to withdraw military support. Investors are betting on Japan and South Korea's military manufacturers, expecting them to fill the gap as Europe struggles to ramp up its own defense production. South Korea's Hanwha Aerospace, a leader in artillery production, has seen its stock rise by 134% this year already, while Japan's Mitsubishi Heavy Industries, MHI, the nation's largest defense contractor, has gained 26% year to date. The momentum continued this week, with Hanwha up 6.8% and MHI soaring 12.2%, following Germany's announcement of increased defense and infrastructure spending. This rally marks a continuation of a broader trend. Since the end of 2022, defense stocks in East Asia have skyrocketed in value, largely driven by increased military spending amid the ongoing war in Ukraine. Hyundai Rotem, a South Korean tank producer, has gained 123% this year, anticipating new contracts from Poland and Romania, while Korea Aerospace Industries has risen 55% in 2025 alone. European countries have found themselves struggling to expand production capacities since Russia's invasion of Ukraine. Trump's demand for NATO members to increase military spending to 5% of GDP have intensified this pressure. South Korea, which has maintained a strong arms production capability due to ongoing tensions with North Korea, has emerged as an attractive supplier for European militaries. According to Dong Ho-jong, an analyst at Mirai Asset Securities, South Korean defense companies could secure up to 154 trillion won, $106 billion in contracts, accounting for a quarter of non-US Western military expenditures. Yong Hwang, vice president at Japanese bank Nomura, expressed on the development, quote, the economies of scale are completely different, end quote, comparing South Korea's production efficiency with Europe's more fragmented supply chains. Meanwhile, Japan, historically constrained by its pacifist constitution, has been gradually increasing its role in global arms exports. The country lifted a ban on arms exports in 2014 and further loosened restrictions in 2023. Japan's defense industry, which currently makes up less than 1% of global arms exports, is now positioning itself for significant growth. Key Japanese defense firms have already seen strong gains. IHI, a manufacturer of rockets and jet engines, is up 21% this year, while Kawasaki Heavy Industries has gained 34% and Japan Steelworks has risen 5%. Mitsubishi Heavy Industries is already part of Europe's next-generation fighter jet project, collaborating with the UK's BEA Systems and Italy's Leonardo. The company is also vying for contracts to build frigates for the Australian Navy, and South Korea's Hanwha recently acquired a significant stake in Australia's shipbuilder Austal. Asian defense companies are increasingly optimistic about future export opportunities. Japan's government is also taking steps to boost the industry, pledging to raise defense spending to 2% of GDP by 2027. In 2023, it increased the maximum profit margins for defense contractors from 8% to 15%, further incentivizing arms production. Japanese policymakers increasingly understand that with growing global demand and uncertainty over US security commitments in Europe and East Asia, Tokyo may have no choice but to continue expanding its military industry. The surge in Asian defense stocks mirrors gains in Europe, where military contractors have also seen their valuations soar. Germany's Rheinmetall is up 122% this year, while UK-based BAE Systems has risen 42.5%, reflecting increased European military spending commitments. As geopolitical tensions rise and European countries look to diversify their arms suppliers, Japanese and South Korean defense firms stand to benefit significantly. With strong production capabilities, government-backed expansion strategies, and increasing global demand, Asia's defense sector is poised for long-term growth. Though, as regular viewers of my other channel, China Update, know all too well, the biggest question is, will these Asian defense companies' weapons be mostly for export, or will they need to be used much closer to home? Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Thursday, and I will see you all tomorrow.